Okay. Right. Cool. Well, good morning, everybody. And those of you who've turned up on time, thank you very much for doing that. I'm sure others will join as we go. Um, with a team, have joked that actually we could all speak over each other over the next 45 minutes, 50 minutes, and we still wouldn't get to the end of all of the content that we want to talk about. So I'm sure those that join slightly later will still have a lot to listen to. So good morning. And welcome to our joint presentation with JPC about commercial property, the tax, VAT, and legal implications around transactions. We'll each introduce ourselves, but just to say that I'm joined with my fellow partner here at Gravita, Sandy Cochrane. My name's Tom Adcock, and the JPC partners, Nick McEwen and James Whiteley. So without further ado, just to sort of explain a little bit about who Gravita are. If I can move the slide, which I now can't. There we go. So who are Gravita? So we are a top 30 accountancy firm, mostly in the City of London, but we also have offices in Ilford and Essex and up in Oxford. And we do all of those lovely services on the right-hand side. But myself and Sandy are very much on the advisory side, tax and VAT, and we help our clients from all over the world navigate that environment. Please don't forget that we also do all the other lovely stuff, accounts audit, and so on and so forth. If you want to find out more about us and reach out, then please use the QR code. It does actually work in the top right corner of the screen, and you can reach out to us directly. James.
And Nick.
Oh,
Oh,
Nick.
hello.
Sorry, Nick.
No, hi, no, yeah. So Nick McEwen here, associate partner at JPC. We're a full service law firm. Obviously, our key areas are commercial, corporate, and dispute resolution. Of course, we have other specialisms on the right hand side that you can see. Our offices are based in Kilburn and South Kensington. Obviously, myself and James on the talk today. We don't have a fancy QR code that Gravita have, but obviously you can easily find us on our website and find our profile and bio and have direct email addresses to contact us. So please do if you have any questions after this talk.
Thanks very much, Nick. Right. So, Sandy, would you like to just say a few words about yourself?
Thank you, Tom. Good morning, everybody. Yes, I'm the VAT partner here at Gravita. Been doing VAT for more than 20 years, nearly double that. I absolutely love what I do. And I think, when people say VAT is a simple tax, probably is, but the most nuanced area is land and property. And hopefully, as we go through today's presentation, that will become apparent. Thank you.
Thank you, Sandy. That's me. That's a terrible picture of me. They did new ones and they airbrushed them all within an inch of their life. So I look younger and weird. But there you go. That's me. I'm a tax partner. I'm a sort of specialist in all the various direct taxes. So I look after companies and individuals and trusts and stults and lots of other weird and wonderful structures from all over the world and how they navigate the UK tax environment. And of course, London being London, a lot of our clients are invested in land and property. So quite a large amount of my day is spent helping those sorts of clients deal with their interests here in the UK land and property market. From those who own a £500,000 property rental all the way up to billion-dollar property developments owned by everything, everywhere, doing everything you can think about with property. And together with Sandy and her team and the rest of the team that work with us, we supply all the services you can think of to those sorts of clients, except the law stuff, which of course is why we work with JPC. So, James, over to you.
Good morning, everyone. I'm a partner in JPC's commercial property department. I do a big mixed bag of commercial property work, including acquisitions and disposals. That could be an industrial estate, it could be a head office of a large company, could be some medical premises in Harley Street, that sort of thing. I do landlord and tenant leases. All the work that goes along with leases, such as licenses to assign, licenses to alter, that sort of thing. I do development work and I do secured lending.
Thank you very much, James. And then last but not least, Nick.
Hello, Nick McEwen here, associate partner here at JPC. That's an old photo of me as well. That we're actually due to take some new headshots. I think a week today actually. So watch this space for a new photo. So I deal with both contentious and non-contentious work. For the non-contentious work, corporate and commercial side of things, acquisitions and the like, drafting commercial agreements, and I work very closely with James in the property department, especially when it comes to dealing with corporate transactions that has a multitude of properties as assets. In terms of the contentious work, the litigious side of things, I deal with high value litigation work to sort of like the fast track matters. And yeah, so and then my role in this talk today, I've got my sort of litigation / dispute resolution hat on. So I will be coming at this from how best to avoid scenarios, or how best to navigate a situation and the like.
Thank you very much, Nick. Okay, so right, that's enough about us, and you'll be very pleased to hear that this is not death by PowerPoint. Right, that is the only slide that any of you are going to see now from here to the end of this. If you do have any questions, there's a chat function within Zoom. Please use that, drop them in. When we get to the end of this, then we'll pick out our favourites, the ones we actually know the answer to, and we'll talk about them. And the rest of you will come back to you after the event today. So please do use that as we go along. Right, so we've broken this into sort of various different bits, and I'm going to act as sort of moderator as we go through and try and keep people moving along as fast as we can to cover the points that we need to cover. So first and foremost, where we're going to start is we're going to start talking about debt. Right, so most property acquisitions require somebody to lend somebody else some money. So we want to talk about a little bit about debt and how not only the tax situation works, but also how the legal situation works and what we see in practice. So first and foremost, let's pass over to Sandy to talk about debt.
Thank you, Tom. I mean, I'm not going to go through the basics of bad debt on this call, but something that comes up quite a number of times is to do with overage payments and the VAT treatment on that, which is still in question when we approach HMRC. So, giving an example, if I sold a piece of land to Tom, and there's going to be a possibility of me getting some overage on that sale at some point in the future, I might actually want to get that funding sooner rather than later. And what I could do is I could say to James, James, will you take that right off me? So basically, I will sell the right to receive that payment to James because I want that funding sooner than when the overage will crystallise. The issue here is how we treat the different payments and who's receiving what. So, it can get quite contentious, it can get quite difficult. And what we found in practice, because HMRC don't really have a specific view on this, we work with JPC or lawyers to make sure that the drafting of the agreements are so tight that we're not asking HMRC for their advice on the VAT treatment, more so that we're telling them. So basically, historically, when we've approached HMRC to get a ruling on the supply, it was far from clear that the supply in this scenario, from me to James, was an exempt sale of a debt. And this is where we need to be really clear, because since then, HMRC have acknowledged that it isn't an exempt sale of a debt. And in that case, that was based on the way that it was constructed. So, using lawyers, making sure you've got the agreements right, understanding the facts, who's selling what to whom and in what capacity will drive the VAT treatment. So I just thought that was a point to raise because we are seeing this quite a lot on property transactions.
I think you make a very good point there, Sandy. I think because we think debt, and we often think structuring, so we think mortgages and we think financing, but actually you can create debt in lots of other different ways, and the VAT treatment isn't necessarily exempt just because it's money. Actually, it could be something completely different, and I think that's really important because these do tend to be quite high value transactions. I mean, from a direct tax point of view, what we care about with debt is whether or not we can get relief for the interest, first and foremost. And I think that's quite important. So when you're lending, when you're borrowing money in order to carry out a property transaction, whether you're going to rent it out or you're going to build something and sell it, are you going to get relief for all of the interest that you're going to be incurring? And particularly if that is shareholder interest. And so HMRC operate holding exclusively. They also, which basically says, did you actually incur this cost holding exclusively for your business? Is it really possible to get 100% loan to value, for example? Is 7% a fairly reasonable interest rate? Probably not. In certain circumstances, it will be, though. And moreover, if you're one of those investors into property that is rather large and your interest exceeds £2 million a year, then it will be restricted if you're a corporate. If you're an individual, it gets restricted much earlier, which is absolutely brutal. And cash flow wise can be very damaging. The other main issue with debt when it comes down to the interest element is withholding taxes. More and more UK property investors are from overseas. Many over the years, of course, already. Most of London is by foreign investors. And the interest that they pay to their lenders overseas retracts withholding tax. And that withholding tax, that's at 20%. So the tax benefits may not be felt in the UK because you're still having to pay the 20% withholding tax. Now there are lots of with double tax treaties that reduce that. There's other devices such as Eurobonds, etc., that can provide relief against the withholding tax. But it's something worth bearing in mind, particularly when going through the legals. Because in the legals, if there's a gross up clause on the interest, which basically says if you have to withhold tax, we still want our net position to be the same as what it would be had you not had to, then you get hit. So you need to be very careful of that nasty little clause, which exists 3/4 of the way through the document, which I'm sure James and Nick will turn to. So yeah, that's me. So James, what have you?
The first point, Sandy just mentioned overage agreements. Unfortunately, when they go wrong, it can be disastrous. I've seen ones prepared by others which have gone horribly wrong, and it would end up with somebody like Nick probably to try and sort it out, if it is sort outable. It is unfortunately one of the main areas of professional negligence for solicitors, even though it's not the biggest area of work, such as residential conveyancing. Do you want to talk about splitting of titles, Sandy or Thomas?
I won't be certainly talking. I mean, splitting of titles is something that it happens, fairly regularly. I think Sandy certainly has some VAT elements to it. I don't know if you want to speak to that just very briefly.
Yeah, I mean, when we're talking about splitting of titles, it's really, really important to understand the nature in which that's done, whether it's through a beneficial interest or some other interest. But we need to be really careful because we've come across quite a number of this recently. We're trying to navigate that with HMRC, who's got the option to tax, who's going to get that, sort of financial reward at the end of the day, needs to be treated carefully. And, we come across this where the split titles and people don't appreciate that we're actually talking about something that's tantamount to a joint venture when a transaction does complete, and then putting that correct structure in place from a VAT perspective. So, yes, it is important to understand the interest that is held under that split title, what the outcome is going to be from a VAT perspective if we're talking about options to tax and commercial property.
When splitting titles, there are a number of ways of doing it legally, and probably one of the simplest, but perhaps not the best, is to just ask the land registry to split the title, and they will usually be a bit confused and ask why you're doing that. And the answer is in preparation for perhaps disposing it to somebody else and to make sure it's separate before the sale goes through. But actually, it's not the best way, because what you have to think about when you're splitting a title is, does each parcel of land have the access it needs to the highway? Does it have rights of drainage and to receive gas, electricity, that sort of thing? And to solve that issue, it might be better to transfer part of the land to a related entity. But then you've got to think about the risk of having to pay, if they're connected persons, you might have to pay SDLT, stamp duty land tax, on the market value. That is a trap for the unwary. And
not to mention capital gains tax.
Capital gains tax. And also, if it's tenanted, you might have to think about check that the conditions are satisfied for it to be a transfer of a going concern. And in that case, you'd have to make sure that the destination vehicle, the company which part is being transferred to, make sure that it's VAT registered and elects to tax and sort of submits an option to tax within the timescale for doing so to HMRC to avoid VAT having to be paid. Because sometimes there is a notion that sometimes there is a price for various reasons, even where it's a transfer from one entity to some sort of connected entity. So there are a few traps for the unwary, and it's why it's very important to get good advice from your multidisciplinary team at the outset.
Yeah, anyone would think that they were trying to put barriers in place for people to do certain things, right? There's so many taxes and legal issues that need to be addressed. So moving on slightly to things called capital allowances. So for those of who don't know, capital allowances are tax deductible depreciation on certain qualifying assets. The UK, and I promise I don't work for the government, but I'm going to say what they would say. The UK operates the most attractive capital allowance regime in the world because it allows what's called full expensing on certain qualifying assets. Basically, if you can spend as much as you like on assets that will qualify for capital allowances, and you get a full deduction in year one, despite the fact that those assets are capital in nature. What are these sorts of assets? Fixtures and fittings, right, to the property, things that are functional within inside the property, heating, lighting, water, desks, chairs, tables, that kind of stuff, lifts in bigger properties, all qualify for capital allowances. So in big property developments, their cash outflow is now matched with a cash tax deduction, which is very, very attractive and is unlikely to last forever. It was introduced by our previous government. It has been retained by the current one. It costs apparently 14 billion a year. We are now listening to the Chancellor talk about scrabbling around for extra cash as the tariffs have started to bite in the markets and the bond yields has gone up again. So watch this space come March, when the next announcement is. But that is capital allowances. From a transactional perspective, buying and selling commercial property, if the seller has got capital allowances there's been claiming capital allowances, you will, as the buyer, if you buy the asset, need to enter into what's called a Section 198 election to agree between the parties what of those allowances you are taking forward. There's lots of rules, there's lots of regulations, but ultimately it's a negotiation. And what you can get will be tax relievable in the future. So if there's anything left over they haven't claimed, do your best to get it, because you'll get full tax relief going forward over a period of years. Very valuable relief that capital allowances is. If you buy the company that owns the asset, you just inherit it. So you don't have that problem to worry about. So I know that there's plenty of stuff on VAT and capital allowances, Sandy, some of which has been caused by what's happened with schools. So.
Absolutely. Thank you, Tom. Yeah. And I think, just to sort of be clear, when Tom's mentioning capital allowances, we have what's known as capital goods scheme for VAT, and the two are generally similar, but from a VAT perspective, the difference is, whilst we would take into the capital goods scheme spend, I'll mention the criteria in a second, the things like tables and chairs that would be available for capital allowances wouldn't fall to be part of the capital goods scheme spend. So, whilst we work very closely with the corporation tax team, when they do have capital allowances, there is a slight difference of approach as to what goes into that capital goods scheme pool for VAT purposes. So for capital goods scheme and VAT, there is criteria where the spend on property, so either by acquisition, by refurb, enlarging, etc., is for a value of £250,000 or more plus VAT. I say plus VAT because that is the issue. I've had a few clients come up to me and say, oh, we bought this property and we think we're in the capital goods scheme. How much VAT did you pay on the acquisition? Well, none, Sandy. Well, then there's no VAT for us to be looking at. So, you know, that aside, when VAT has been incurred, the other we need to look at the use of the property. So when we're looking at capital goods scheme, we spend, let's say, £1 million. You've got £200,000 of VAT thereon. So you look at the use of that property over the next 10 years. And I'm trying to emphasize the word use. It's not when the money was spent, it's when that property is getting occupied. So as Tom alluded to, you know, with the schools, they tend to do a lot of spend in the summer holidays, but the classrooms aren't actually going to get occupied sometimes until January or, you know, the following year. So with those schools, they may have spent a lot of money refurbishing their gym, the dining halls, or, you know, the areas that they are looking at refurbishing, but they're actually not using them until last month when the schools were VAT registrable. So we are working with a number of clients there to work out what they can reclaim under the capital goods scheme. And it's quite interesting calculation. I did one on a disposal summer last year, and to go through the spend took a lot of trawling through, but it was really useful. In that case, it was part of a transfer of a going concern. So as James mentioned earlier, if you've got a situation where the transaction is going to be a transfer of a going concern, the capital allowances will normally transfer to the buyer, and they inherit the remaining intervals that are under that capital goods scheme. And what we do quite well is we provide calculations to ascertain that position for the buyers under the under the legal requirements. And again, having the legal contracts drafted up in such a way that captures all of this is really, really important. So hopefully, without me going into too much VAT, but just on the surface, capital goods scheme can be a really good way to get money back, but it's really, really important to understand the use of that property and what we're thinking of using it for over that 10-year period.
Absolutely. And look, I think the VAT on schools is certainly not a universally liked policy that has been introduced, but has created us some work. So those that are involved with schools, then please do reach out if you're still struggling with the transition. But also, capital goods scheme applies not just to schools, but to like everything that's caught by it, and it can catch you out, as Sandy has just been alluded to, because of the use of the asset. Right. So capital allowances are very much a tax thing. So we've heard a lot from tax people. So let's move on to the commercial property standard inquiries that CPS. Oh, sorry, James.
There's one point I was going to mention about capital allowances, which is that if there's a transaction, parties should really think about this at the heads of term stage before the lawyers get involved.
Very good point.
They need to make sure so everybody's clear at the outset what's going to happen with capital allowances. Otherwise, what will happen is the seller's lawyer will put in the section 198 election, which is a draft of which is attached to the contract. They will put a value of £1 on of the purchase price. Okay, £1 towards the items which attract the capital allowances, because they perceive that, and probably they may well be correct, that will give the seller the ability to claim, and
it will
prevent the buyer from claiming anything, really.
It's a neat trick if you can get away with it.
But they always do
on the
it.
seller side.
And it's difficult to argue. It's much easier to argue before it goes to lawyers, because lawyers make things a bit tricky and argue different various points. And
isn't it always the case, though? To be fair,
and as you're going on to the CPSEs, the CPSE 1 inquiries do contain quite a lot of inquiries related to capital allowances. And one of the things that you have to put in there is who the expert is who's dealing with them for the seller. And that was done because people are getting themselves into a big muddle over capital allowances, is causing difficulty. So so make sure you've got your Gravita's capital allowances experts lined up for you before you start the transaction.
I don't disagree. But going further into the CPSEs, because there's an enormous number of questions. I know, Nick, this is one of your areas of speciality. So
Yes.
if you
Yes, it is. I don't think it can be. Well, first of all, something I wanted to sort of say towards at the start, and what James touched on just now, is that when ever starting a transaction, you should, and the CPSE also already alight to this. It's like you should have your finance team in place, your accounting team in place, and legals at the same time at the outset, at the earliest possible time, because I've seen numerous occasions whereby I've had clients come to me with a transaction and they haven't got accounts lined up, and it just slows the process down. They're not aware of things, and as you've Tom and Sandy I've already spoken about earlier, there are so many things that a client can be caught out upon, aren't aware of, and it's just a minefield. And this needs to be, the point is, it needs to be addressed as soon as possible, as early as possible, to ensure the client gets the best outcome as soon as possible. But yeah, so going on to the CPSEs, it is an extensive document, as everyone knows. Its length, it's significant in its disclosure requests, and it cannot be overstated how important it is. It is effectively what becomes the anchor of a person's decision to whether to press ahead or not. The answers that come out of it are so important, and it enables a buyer to make an informed decision as to proceed and identify any issues or things that needs to address in the future. Now, legally speaking, obviously, what is a seller's duty? I'll run through the legal legalities very broadly. Obviously, all legal matters are usually done on a case-by-case basis, but broadly speaking, a seller's duty that they have no duty to disclose in common law, but their only obligation really is to disclose if there's a latent defect in the title. So now it comes on to the buyer's role, effectively, is then to tease out the information from the seller to get everything as much as humanly possible out of them, and to ensure that there are follow-ups to those answers. Obviously, you never get all the answers in the first round. There's usually follow-ups and further questions and the like. And it's usually often the case whereby, and I think that there is certainly case law more recently where it's imposed upon the buyers and more so the solicitors. There's a case I think Bird and Bird have been involved in the past, whereby they have an obligation to their clients to ensure that any issues, any gaps in the inquiries, make sure that they are addressed accordingly. So it's almost, it is very buyer heavy when it comes to disclosure, but it's also incumbent upon them to ensure that they follow up with the seller in any of the response that they get to the inquiries. Now, the timeless question of the seller's best knowledge, at the time of disclosure, the buyer often puts the seller on the back foot and says, okay, to the best of the seller's knowledge, do they know about X, Y, Z? And then there comes the question of what does it mean to have the seller's best knowledge at the time of the transaction? And then it comes down to quite an old case. It's like 1993. It's been around for many years, and it's still good law. It is still referenced now to more modern cases, and it basically highlights that there is an obligation for the seller to do the investigations needed to ensure that when it gives the answers, it's just not giving it willy-nilly. It's not just saying, "Oh, I think it's the answer is this and that." It's obviously, again, case-by-case basis. For example, if it was like a corporate transaction with property involved, it would be incumbent upon those in the corporate entities to do the relevant, make the relevant inquiries to those who they need to within the company to ensure it gets the correct answers. But also there is as we know, both James and I have worked on transactions that have spanned over many months, if not longer. And when an answer is given, there is still an obligation for continuing representation. So what that means is, if an answer is given, let's say, start of this year, and then a transaction finishes towards the end of the year, it is an obligation upon the seller to ensure that that representation still remains the case. And there is case law to suggest that if it came about and something that the seller ought to reasonably known at the time, well and good time before exchange and completion, that the representation has differed from the original representation that was given in January, then the seller is potentially on the hook for misrepresentation.
Sounds like a good reason to try and do the transaction as quickly as possible.
Oh yeah. I did, in an ideal world, that's what everyone would write. But obviously, we know where reality isn't always the same like that. But yeah, and then it comes down to, and that sort of nicely segues into misrepresentation. Obviously, a seller's obligation when asked is to give a truthful answer, and it is often the case when with profane claim that the starting position is, you look at what the actual answer, what the question was asked, the answer was given, and what actually has transpired, and see if it can be, if the lawyers say, well, that what at the time that the answer was given, was the correct investigation followed, and the seller of knowledge, can that be instilled in the case? And it's a judgment call for us lawyers to advise a client, look, here's a scenario, we think that you're going to have some hurdles here, and here, but then also at the same time say, well, we have them on this point, and this point, and that point. So yeah, it's just, again, going back to the beginning, it cannot be overstated how important this process is. It forms sort of like the bedrock of the decision to be made for the buyer to enter into the transaction, and to ensure that there has a huge degree of much of a protection as possible after the transaction has taken place, to ensure that nothing crops up afterwards that doesn't cause them financial harm and difficulties later on. Which then, if it does, then it comes to people like me and asks them to
indeed
get some money back in shape or form.
Indeed, and I think you've outlined the reason why it's so important. The answers to those initial inquiries are fundamental to structuring the deal. And I think we're now going to move on to sort of a whistle-stop tour of sort of acquisitions and disposals, some things that have sort of cropped up in recent times as a response to CPSE, because it doesn't just cover the legals, of course, it covers VAT and tax and lots of other stuff to do with debt. And one of the things that cropped up quite recently just highlights this particular issue, which is that we discovered that we were acting for the buyer, and we were buying some property, this company, from a third party, and it transpired that despite the fact that these properties have been let out by this company to individuals, the company had never filed a tax return with HMRC, which was a bit foolish. So we had to make sure that there was some returns that were filed for the last 15 years and dealt with the tax accordingly. But it'll also throw up a number of other questions, which to do with debt gearing and other stuff that we've touched on already, capital allowances. Because that's what the CPSE inquiries do. They enable us as the advisors to really understand what the seller's been doing, what the buyer wants to do with the property going forward, and how we can help them navigate through this to the end. Because the reality is, there's always something missing. There's always something that needs to be a little bit further explored to understand it, particularly in the world of VAT. And I know we've touched on transfer of a going concern before, but one of the big issues on the buying and selling of property from a tax perspective is, what is it a transfer of a going concern? So, Sandy, over to you.
Thank you, Tom. Yes, and you may recall, I'm going to talk about a transaction that you and I are involved in, and it was to do with the vendor of a property, and it was the 15th of December 22. I'm not going to forget this because football was on, not that I'm a football fanatic, but it was 8 o'clock in the evening, and I was about to watch the match, and we got a call from the vendor talking about this transfer of a going concern they were completing a couple of days later. And the issue that arose that they weren't aware of, and neither were there, it wasn't JPC, it was another form of lawyers, I hasten to add, they were not aware of the requirement to have a VAT number where we had a transfer of a going concern, where the future rent meant that the purchaser had a voluntary registration obligation. And in this scenario, they had to provide the VAT number prior to completion for that transaction to be capable of being treated as outside the scope of that as a going concern. So there are two types. So when you do a transfer of a going concern, in most cases, it's the transfer of a rental business. So you have what's known as either a voluntary or a compulsory VAT registration. A compulsory VAT registration is where the purchaser is going to receive income in excess of the VAT registration threshold within the next 30 days. That threshold is 90 grand. Voluntary is where they're not. So you can see the slight nuance there. And, unfortunately, this was a case that was brought to us, I think, a couple of weeks before the transaction. So with the best intention in the world, we would have never got a VAT number off HMRC. As it is, they're taking 40 working days to process applications. So, big lesson from that is, let's start talking to advisors when we're thinking about doing something, not when we're about to sign on the dotted line. So
Absolutely.
yeah.
Absolutely. I remember it well, Sandy. As soon as you mentioned the football, I was like, oh yeah, that ruined
that
that
one, absolutely.
And all I have to do really normally is watch the football to ruin my evening, so that's fine. So but it does lead on to some other sort of bits about the negotiation and getting people. And I know we're going to say this, of course we're going to say this, get us involved early in the conversation, because not only have you got the VAT stuff, but there's also negotiation over the price. Okay, so if you're buying a property and it's held by a company, which most commercial real estate is, so we're focusing on that. That property will almost certainly have what's called a latent gain within it, i.e. today is worth more than it was when they bought it. Okay. So if that company were to sell that property, it would pay tax at 25% as it stands today. Okay. So if you're buying the shares of the company, you don't necessarily trigger the gain on their underlying property. You can do, and I'll come on to that in a second. But when you're the buyer, you're looking at it, you go, if that was sold, there's a tax liability, and I don't necessarily want to pay all of that tax, so I'm going to try and negotiate away part or all of that potential liability should that property be sold. And of course, as the seller, when we act for them, we're like, no, hang on, we've got no control over when you're going to sell this property. You can do with it what you want. We're not paying all that tax. It's crazy. You can keep the purchase price up there. Thank you very much. So we have that argument, and then it gets balanced with stamp duty. Because the difference with stamp duty is because if you buy the property, you pay, if it's commercial, 5% roughly, and if it's residential, all the way up to 15%, 17% sometimes if you're super lucky, right? So these are big numbers. But if you buy the shares of the company, it's only 0.5. It's a big saving. So as the seller, you can also make that argument. You say, well, okay, but we are saving money by buying the shares. Okay, so there is this sort of play off between the two, and it comes down to maths. And then it comes down to whether or not you as a seller and you as the buyer are happy to settle on that particular number. You add into all of this, by the way, of course, capital allowances, because that's called deferred tax assets for the purposes of this conversation. Because if you don't get it for £1 and you get it for, say, £1 million, then that's worth £250,000, thank you very much, in tax saving in the long term, which is quite nice to have. So there's those to be brought in. But where's the trap? The trap is this. If the company holds the property as stock, because it has decided that it was going to buy, say, a plot of land, build a thing, and then sell it. But instead of selling it sells the shares of the company, because you as a buyer don't want to pay stamp duty of 17% on a residential block of flats, because you really don't want to do that, right? Say, okay. And yes, I know more than 6 and all the rest, but let's say. So 17% is a big, big price to pay, right? But you as the buyer don't want to hold this as stock. You're going to hold it as a long-term investment. You're going to rent it out. So what happens is when you buy it, that asset goes from stock, which is one part of your balance sheet, to another part of your balance sheet, which is fixed asset investments. If there is a gain between what is held as stock, which is the lower of its cost, and what they call net realizable value, right? Which is like if it's less than it costs you to build it, and its market value today, which will be quite clear to see because you know what you've just paid for the company, there is a tax liability. There's a dry tax charge. There's no cash. There's a dry tax charge in the hands of the company. You've got to pay tax on that. That's quite nasty. So you need to just watch out for that one. That's one point. Going the other way, fixed asset to stock, there's a relief, but there is no relief going the other way. So just please bear that one in mind. So just very recap, really important that you get the advisors, the tax advisors, as well as the lawyers involved from an early stage to talk about to the transactions themselves. But Nick, I think you had some other points as well, particularly on due diligence,
Well,
which
yeah,
fits CPSE stuff.
Yeah, well, it's saying, like I said, I think it's a case whereby often the case if you haven't got the party or the advisors at the start of the transaction where things can be found out very quickly. If it's the case, and I've had it before, whereby a transaction that the tax advisors came on midway through, and then obviously it changed a lot in terms of the financials and the tax elements and things like that weren't known to the parties at the time. And then it comes to the question of, well, okay, we need to go back to the original sale contract, and we need to talk about the price, please. And it's like, well, okay, let's do that, and we have to hash it out, and at the time, and then it comes to the question of being commercial. Does the buyer and seller want to offset or increase, decrease the value accordingly? And obviously, it's ultimately a decision for the client. But obviously, in circumstances like that, depends on the wrong word, who's at fault, as it were. It gives a party a leverage in terms of the transaction of what comes out of the wash and the due diligence of how they can best use that to get the best outcome in that transaction. But to avoid, my point is to avoid those situations. This again, it's just coming back. We can keep drumming on about this, but it's so true. It's just to get the proper teams in place as early as possible, so you avoid those awkward conversations midway through transaction. Yeah, that's my
absolutely. I mean,
Yeah.
It really is a joined up effort when we go through these transactions, just to make sure that the VAT, the tax, the legals, everything all comes together, so that people are not only aware of what's going on, but also that they can sort of negotiate their way around it. Because sometimes it just does come down to money. So that's just money. Right?
Sorry, Tom, I was just going to mention one more point, if I may. So when we're talking about these sorts of transactions, we were dealing with one about a month or so ago, where we had a property opted to tax. Tenant would have disapplied the option to tax because of their use. And what we did, rather than our client being the vendor of the property, making an exempt supply, well, they made an exempt supply, obviously. But what we managed to do was renegotiate the price of the property. So the seller was increased that by the amount of irrecoverable VAT they were going to suffer. And that worked really nice, and the purchasers were quite amenable to that. So there are different ways of approaching it as well. So I just thought I'd mention that.
No, I think it's really important. Sometimes you have to affect that there's a tax damage to it, and you just have to negotiate your way through it. I think it's all part of that conversation. Willing buyer, willing seller, it isn't just the price necessarily, it's how you come to that price.
Exactly.
And you have to take these things into account. And it's right you have to get it right, otherwise, chickens and roosts and all that. So moving on to just another part of transactions, of course, is reorganizations. And looking at fund structures and how things work and how they need to be changed from time to time because of regulatory reasons or tax reasons or legal reasons or family matters that come about. And I think from a tax perspective, reorganizations are complicated, and there's lots and lots of moving parts. And when we're talking about reorganizations here, we're talking about group structures, moving assets or moving companies around inside those group structures, sometimes cross borders. And you have to take into account all the normal taxes. So corporation tax, SDLT, VAT, of course, and others in between, even income tax from time to time, because of who the shareholders are. And if you've got non-UK people involved, then it's non-UK stuff that you have to look at as well. We work with our partners from DFK, which is our international organisation all over the world, to help with that. But there are a couple of things just to bear in mind. Whilst you may get relief from day one on transfer of property from company A to sister company B in a group structure, there may be no capital gains tax or SDLT, for example, on the transaction on day one. There are triggers that can bring those taxes back into charge within 3 years for SDLT and 6 for capital gains. And it's fundamental that you maintain the sort of the silliness sometimes of these structures to go past those dates. So often we'll build structures with dormant companies sitting within them to continue, so we continue to hit the conditions of the legislation, so you don't have these clawbacks or degrouping charges, as they're called, on transactions completely by accident. You know, I've seen a situation where 5.5 years after a transaction took place, an event was about to happen, which would have triggered a tax on something that happened 5.5 years ago. And it was only because I sort of sat there and went, hang on, wait a minute, I remember doing something with this. How long ago was that? And it turns out we were still inside the window, so we pressed pause and we waited, because it would have been about £500,000 worth of tax, which is quite a lot of money for pretty much anybody. So I think that's quite an important thing on reorganisations. They are very complicated from a tax point of view. There are clearances available from HMRC on some of it. So we can write to HMRC and say, this is what we're planning on doing. This is why, right? So there's no avoidance motive behind this. It's purely commercial. Bless our transaction, please. So you're going to not tax us on various different elements of it. They won't clear all of it, but they'll clear parts of it. And then we can also write to them and say, pretty please, on some of the other bits that they don't have to clear or give us an answer to. And sometimes they'll come back and be nice and say, yes, that's absolutely fine. But it's definitely worth going down the process, particularly with complex reorganisations, particularly with complex transactions, because being upfront with the revenue actually isn't a bad thing, because telling them what you're going to do often puts them into a conversation with you before you've done something. And if you can do that, and if they've got a problem with something you're doing, either you've got to explain it better or differently so that they can understand it, or tweak your plan, tweak your process so that you actually do fit within what HMRC are expecting, which is, I think, a really good thing to do. And I know, Sandy, I think you can do something fairly similar with VAT, although it's not quite as clear cut as it is with direct tax.
No, absolutely. And I think, you're absolutely right, Tom. And I think one of the, we get a number of issues, but in reorganisation, one of the most typical issues that we're faced with, and one that happened several years ago, is reorganisation of companies. One of the companies thought it wasn't trading. It decided to deregister, forgot that it had, as you do, forgot that it had a property that was opted, and HMRC stung them with 975 grand because there's an exit charge on deregistration, and that's based on the market value of the asset that you have. And unfortunately, they had a rather high value property. So, reorganisations, aren't to be taken lightly. And, that's one incident that was 975 grand of VAT. But in my time of doing this, that's not the first, it's not the last. But let's hope people on this call won't get in that situation. And at least have the awareness that, reorganisations can create something, and you just need to be careful.
Absolutely. And I don't know, James, there's a bit on debt here as well, because we talk about the assets and we don't necessarily care so much about the debt, because we can shift the debt for tax purposes, no problem, usually. But James, I think you had a few points on debt structuring and how that might be effective from a legal point of view, particularly if we're moving assets from company A to company B.
Yeah, well, you can sometimes, sometimes have a situation where related companies or companies which are, sometimes it could be to do with pension funds, which are both within the same family, and sometimes there is one of the selling company will charge a purchase price to the buying company, even though they are kind of all a family sort of pension fund arrangement. And it's very easy for the lawyers to think to forget that it is still a transaction, and they need to think really about SDLT and VAT. In fact, VAT is probably the first thing they should be thinking about, because very often these companies own tenanted properties. So it becomes a transfer of a going. The idea is to make it a transfer of a going concern. When we talk about the option to tax to charge VAT, the basic position with property is there is no VAT on things like rent, even for commercial properties. But a landlord can choose to charge VAT on rent, and they do that by submitting an option to tax to HMRC. And there could be various reasons for that. They might have paid a lot of VAT to some building contractors or some whatever, and they want to recover it through throughput tax. Anyway, the danger with this transaction of this sort is that the buying company really needs to have its ducks in a row at the start, and that means it needs to, as was said previously, have a VAT number, and it needs to submit an option to tax, its own option to tax, which has to be notified to HMRC, I believe, within 30 days of the transaction. And I have come across a situation where there was a failure to do that. It sort of fell between the accountants didn't do it and the lawyers didn't do it, and
Wasn't us, by the way, just so everyone's aware.
yeah, exactly. But nothing really bad happened. It was discovered on a VAT inspection. I suppose that's when these things do tend to come to light.
Typically, yeah.
And fortunately, there was enough throughput tax to pay the VAT on the purchase price. It was very lucky, but you can't rely on luck. Always be.
You can't. Also, penalties start to kick in.
Exactly.
I think you're leading this quite nicely to James and sort of the final part of what we're talking about today, which is where it all goes wrong. So I think the war stories are the bit that frankly teach the most when it comes down to what can go right and what can go wrong, and there are hundreds of them. I'll let Sandy start. Go on, Sandy. I'll let you start with your favourite, if I can call them that.
Are you alluding to anything specifically there?
No, I'm sure you've got many, but which ones this morning is the one that comes to mind?
Okay, so war stories, as Tom's saying, there's loads and loads of them. I think talking about property, I'll sort of move on to a slightly different area, but DIY claim. So, the DIY claims, they extended the requirements. So once the build is completed, the builder was able to collate all of the invoices, give them over to HMRC within 3 months. That's been extended to 6 months. But what is happening and what HMRC do not like, and it was a case law, was when you do your DIY claim, you then decide to do something else on the property, so you submit a subsequent claim. HMRC are not allowing any of those, so our client lost a little bit of money on the VAT front, hadn't told us about this. We helped them with their original DIY claim, and they took it upon themselves to put the second one in, and then have asked us to help them get them out of trouble. I mean, they are where they are. There's not really much we can do after the event, but on a simple, what he thought was a DIY claim, it was looking at the rules and him not understanding, and just coming to us a bit too late, really.
Yeah, and it happens so often, right? It's after the fact. It's a shame, but you can't really do much. Mine, I think the one immediately comes to mind is it's a fairly sizable property transaction here in the UK, financed from an Israeli bank, and it had that horrible clause, it turns out, in the agreement, which said we're going to gross it up if you have to withhold tax on the interest payments that we made on this loan. The reason for that is that the Israeli lender is exempt from Israeli tax, and therefore they don't want to suffer tax because they can't recover it. Basically, withholding taxes are saying, Israeli bank, if you were a UK bank, you would have to pay tax. Therefore, you're going to pay tax on withholding as opposed to being on corporation tax here in the UK because you don't have a presence here. So you sort of sit there and go, that's not great, because the gross up clause costs a fortune because it's the 100, right, less the 20 grossed up. So you end up paying 130 something % of what you were originally having to pay. Now, fortunately, there's a wonderful piece of law called Section 888A, which people like me know, and not everybody else does, which says that if it's a private placement, so it's north of 10 million, don't know why the threshold's there, and you basically have a letter agreed between the two of you, which you keep in a drawer, don't even have to give it to the revenue. You can get full relief for the interest, and you don't have to withhold the tax. So it is a lovely piece of legislation which was brought in sort of somewhere in the depths of the 2012 Finance Act from memory. But that was mine. So yes, there was a problem, but we found a solution, which I think is quite important because we got there at the right time. And typically with direct tax, You can do some things after the event has actually taken place, because there are little things you can do. We can work with lawyers to make changes to agreements. We can work within our framework of our legislation with double tax treaties and what have you, in order to get to a better answer. Can't always, but that's what we tried. So Nick, James, which would you do if you wants to jump forward with your?
Oh, I've got a couple. I only say a
You've got
couple.
to, yeah.
Unless you want to go first, Nick. Do you have
No,
any?
no, yeah, your stories are
One that's got a great one on
yeah.
ransom strips, which is the ransom strip
Yeah.
story.
Well, that one was a bit. That one is a bit of an anticlimax because it
Oh,
looked like a. When I did, it looked like a ransom strip because part of the highway happened to be within another title which was surrounding my client's title. So the buyer correctly said that looks like a ransom strip to us. But that's what I did. I went on Google Street View and you can see it was actually the pavement of the road outside. So it had definitely been dedicated as part of the public highway. So that was a good solution.
that
But
is a good solution.
the most worrying ones are when you get a client who says, I've got a restaurant and I want to assign my lease to somebody else. I'm selling the restaurant. And they give you this lease. They negotiated it themselves. They didn't have any lawyers. And they didn't realize that you sometimes have to pay SDLT on lease rent, okay? Stamp duty land tax. They didn't realize it covered commercial leases, and they didn't realize that it was registrable at the land registry because it was more than 7 years, the lease term. And this was, I think, 12 years after the lease had been granted. So unfortunately, I had to write. I have this standard letter. I don't tell HMRC. I've got this standard letter I sent to HMRC. And I said, my poor client didn't understand. You know, they hold their hands up. They didn't realize you had to pay SDLT, and please could you let them off, because the potential penalty is basically double the SDLT. So you have to pay the SDLT and some equivalent to the SDLT as a penalty in a case like this, which is so many years afterwards, and plus interest, of course. And my client got let off with a £200 penalty.
Nice.
But still had to pay the interest. But then, unfortunately, I got a letter from HMRC complaining they hadn't paid the £200.
You can walk a thing to water, right?
Yeah.
But I had another one. I acted for this client who had an office building. It was a company. I had an office building with lots of different offices in it, and I used to do the leases for these offices. And then it all went a bit quiet. I didn't get any instructions for a long time until finally I was told by my client I want to sell the building. And it turned out there were loads of additional leases which the client had done himself, the director had done himself, using my precedent.
Nice.
Unfortunately, he hadn't done it in such a way that the tenant didn't have a right to remain in the property at the end of the lease, and the buyer didn't like that. So luckily, all the affected tenants were friends of my client, and they all agreed to surrender their leases and redo it properly. So it was a happy ending. But it probably
Listen, look, and I know there are plenty of clients listening.
it probably ended up costing more
Yeah.
if they'd come to me to do all.
And that's the thing. That's the thing. I think a lot of these stories really come down to actually, if we'd done it first, then it would have probably cost everybody less.
Yes.
Nick, last but not least, and I know we're very close to the end of our session. So, Nick, have you got a quick little war story that you want to share with us?
No, I mean, I think James beat me to the story I wanted to say, and it was like it's not totally uncommon whereby you give a client a template to work from with the view that is going to be you're going to be given the instructions to pass on and get approval and it's signed off by everyone, and then let's say they go dark, and next thing you know, they're coming back to you a couple of months later saying, "Oh, got an issue here. Okay, great. Okay, I can try and help you out with it. What's the legal document surrounding this, and what's the look at the lease and this?" And then you look at it, it's like, hang on a minute, I drafted this, but you haven't done it. Wasn't complete because we need further instruction for you, and you just run off with it. And yeah, and like I said, it causes more issues long term than if you just stuck with us in the short term. But yeah,
It's always the way.
Yeah.
So we had one question that dropped into the Q&A box, and it's to do with VAT, unsurprisingly, Sandy. What a massive surprise that is. So, and the question is it possible to retrospectively submit an options of tax notification, assuming you had always intended to elect prior to purchase? And if so, how do you go about this? and evidence do you require to prove you did opt to tax, even though you didn't submit the form to our friends at HM Revenue and Customs?
Okay, so yes, there is the potential to do what's known as a belated notification. There is a requirement to have the evidence of the intention to opt to tax at the time. That can comprise of a number of things. One, documented in board minutes, conversations during a board meeting, or even by issuing VAT invoices to tenants historically, so it proves that you've always intended and wanted to charge VAT because you have done so. And that's very high level. Devil will be in the detail, but usually, yes, in answer to that question, belated notification is probably the way to go. And then, yes, evidence to demonstrate that intention is 99.9% required by HMRC.
And often HMRC don't refuse them because they want the money. So it's if it's the right thing to do, then definitely Sandy and her team can help.
Well,
So
we got a client off a £1 million assessment not too long ago, funny enough, doing exactly that. And the evidence we provided were the contracts that the lawyers had kindly drafted that said what needed to be done. They did charge VAT, and it just transpired it was an oversight. HMRC accepted it, so yeah.
there you go. So look, well, first of all, thank you everybody who's stayed with us throughout the hour, listening to us. As I said at the beginning, we could talk over each other and still be going now for all the stuff that we want to say. So we've tried to pick up some bits which we find interesting, and I hope you did as well. Please do reach out to any one of us, either Gravita or JPC, or anybody else that you happen to know at those firms, if you've got any questions about property or anything else, frankly, that you think we might be able to help with. Again, thank you so much for coming along and listening to us today, and I hope you all have a lovely Wednesday.
Thank you,
Thank
everyone.
you,
Good night,
everybody.
guys. Take
See you
care.
later.
Thank
Bye.
you.
Thank you.